In this video, let us learn about straddle and strangle. There are two types of straddles and strangle. One is long straddle and one is short straddle. Okay, so if you buy at the money call option and put option of the same strike rate is called as long straddle, and if you sell same call option and put option with the same strike rate is called as short straddle. So in the same way, it happens for the strangle as well. If you buy out the money call and put, it is called as long strangle, and selling out the money call and put is short strangle. Today in this video, I will show you my screen and I'll explain you in detail about the different risks involved in it and how you can automate these things without any coding by using different technologies and how you can automate that. Let me share my screen so that you can understand better and it will be easier for me also to explain you in detail.
Platform to explain you the straddle and strangle. So both these two strategies are non-directional strategies. Okay, first you need to understand what kind of strategy it is, so that it will be easy for you to deploy it and understand the risk. So if at all, if you feel that the market is in sideways and you if you want to enjoy the time decay, the premium decay, what it happens over a period of time, if you want to have that kind of trading in your mindset, so straddle and strangle will be the right things for you. So here, I hope everyone is aware of this short straddle and short strangle. Today, I will explain you in brief, and I will show you how you can automate these things in the platforms where it can you can define in multiple time frames and you can do some adjustments as well. I will show you in detail. So let us understand first about the short straddle. Okay, so here if you see, it is already a ready-made strategy. Short straddle, if you click it, so it is taking at the money call and put. It is selling, right? So at the money, what is the Nifty now? It is at 20,900. So it is selling 20,900 call and put. So this strategy is actually you have to implement whenever the VIX is high. Otherwise, you will not get much premiums out of it, right? So today we will see how we can see this is already December. In this week, it is already done. Today is the expiry, right? So we have to change it to the next month, next week expiry. So if you sell this both call and put, this see here, if you will get a breakout half, this will work like a pyramid. So you are collecting a premium of 85 rupees and 166 rupees. Combined together, you are collecting about these two premiums. So the collected premium will be 12,550. That is what it says, like the margin needed for this is 1.25 lakhs. Okay, and the probability of profit is 57%. So this short straddle, you can deploy it in the morning. Many people deploy it in the morning, so that if the market is moving sideways, so they will be get benefited by the theta decay. So theta is like change in your P&L after one day if nothing else changes. Say suppose tomorrow also if Nifty closes at 20,900. So you will get 1,080 rupees is the one. Like that, you can have, say, if you do it on Friday tomorrow, and what happens if the Monday, if it's again closes at 20,900, you already get 3% returns kind of things. 4,500 you will be having it if market closes. So if the market is at say 20,900 at 10:30 you'll still have this 4,200 in place, provided the VIX is the same. Provided the VIX has to be same. If the VIX increases, there may be a chances like you will get a higher premium. But still, if you see it on Monday at 11:30, if you make this straddle and if you are keep moving, see sometimes what happens. There are interest rate straddles also you can do, positional straddles also you can do. See, it's till Thursday. If it is on 14th December, if you keep it, you will get the whole premium. See, 10,700 if it closes at 20,900. So we can, to be precise, you can change any number. See, even if it is closing at 20,000, say suppose 800. So what happens if it closes at 20,800 on Thursday? So still you will be in a profit of 7,600. So what if you have a closing at 21,000? So still you will be in a profit of 7,000. Where will you occur loss is like over and above this range. So 20,640, you can have the same figure here, 20,650 and 21,150. In this range, if Nifty closes, you will make a decent amount of money. That is how people uses this for a non-directional trade. If the market is non-directional, people always go for straddle and strangle, positional straddle and strangle. This you can implement in intraday as well. So as this is a short straddle, I hope everyone understood. I will show you the different uh, parameters how you have to adjust it in the intraday when you are automating this trade. So in the same way, if you buy both call option and put option, this is called as long straddle. So if the market is closing at 20,900, you will lose almost the 12,500 premium, whatever you have given, right? So you will make profit only when the market moves down beyond this 20,650. You will come to the profit on the date of expiry. And in the same way, on the upper side, 21,150 over and above, if it is moving, then you start making profit. So the profit will be unlimited here because it can move on any direction. And in short straddle, the profit will be limited and you will have unlimited risk. I will show you how you can mitigate that risk as well. If you buy the hedges, that will be cut off. Uh, so the probability of winning is 43% in long straddle. So the probability of short straddle will be always high because option selling, the probability will be bit on a higher side. So this is about long straddle. So in the same way, let us understand about the strangle. And in details, I'll be talking while showing you in the application while we are building the strategy. So let us understand in a simple way what is long straddle and what is short straddle so that you will get a rough view on the payout chart and margin required, everything. So this is all about the straddle. So we understood the long straddle and short straddle. Okay, so usually when you have a very big event, not sure about what is happening in the market, and the VIX is high, uh, you can go for long straddle. And if there is no event, the market is in consolidation mode, and you are not expecting any big move out of it, you can go for short straddle. So short straddle, you will enjoy the time decay, theta decay. So it is advisable to short it whenever the premiums are higher, the VIX is high. Okay. And now let us come to the strangle. So strangle, what did I say? Like it is selling OTM. So OTM is for like out the money options, right? So out the money call and put. Selling call and put of out the money is called a short strangle. So short strangle to sell it 20,900 is the at the money strike rate. Out the money PE. Out the money PE will be and out the money CE call will be different. So if you want to sell out the money put, so first let us understand the options like at the money, in the money, and out the money. You need to know this before you go because in Strangle you can sell out the money one, out the money two, out the money three. So say suppose if the put option out the money. Out the money means so you have to go if Nifty is at 20,900, right? 20,900 20,800 put. So 20,800 will become out the money 1. 20,700 will become out the money 2. So here, let me change it here. So it is having a 50 rupees strike rate, right? So you can go for 20,000. This will be the out the money. See, the premium will decreases when you go for out the money, right? So this is out the money one. And for call option, it is vice versa. You have to increase. You have to go above to 20,900, 100 points. So selling 20,100 call option, that will be out the money one. So you can sell out the money one call option and out the money put option. So the strangle payout looks like this. It is very similar to the straddle, but it's not like a pyramid. So you will get a range as we are selling out the money call and put. So you will get a bit wider range, okay, and the probability also slightly increases. So you will go under loss. This is the break even point, and this is the breaking on point. There is no hard and core rule that you should go for OTM 1 and OTM 2. You can have multiple straddles. See, if you are selling OTM 2, say, OTM2 is out the money too, right? If you decrease it by another 100 points, so 700, 800, 900, 200. This is OTM2 put option, and this if also will increase. So the range increased. If you observe here, the probability also increased, and the profit also decreased, right? Profit decreases because you are going in a still wider range. The margin requirement would be the same 1.25 lakh for Strangle. So selling option, like if you want to hedge it, you can hedge it with any of the options to minimize this margin and minimize this maximum loss. It is always good to have keep the hedges in your account so that you will come out of this unlimited risk, right? So let us see 20,900, what kind of hedges you can buy here. For straddle also you can buy, and for the strangle. So once you buy and keep it, you can just leave it. Let us see call option last traded price 20. So let us take the next week. Okay, we have sold here. You can choose to sell here as well as I was doing using the indicator. So 30 and 30. So this is called as delta neutral strategy. Also, you have see if you see the option Greeks, if you want to make it as a delta neutral strategy, you can sell this and sell with the same delta. See if you see here theta, vega, gamma, and put delta. If the put delta is point, if you are selling 20,100, this point 0.3 is the delta, right? So if you want to sell the same delta neutral strangle, you can sell 20,850 instead of going through the exactly OTM2. So you can choose either of the way. So either delta neutral or see this, if you choose this and there, okay, so it will be keep moving. If you sell double the quantity of, so it will be an expanded mode. If you see the probability also will increase. So likewise, you can sell out the money call and puts in uh, different strike rate and still it work out. Okay, so this is all about the short strangle. I hope everyone got clear here. So let us understand long strangle. Long strangle is nothing but you buy, say, this will be the limited loss, maximum loss. And if there is a movement over and if there is a very big movement, then only you will make money till the expiry. So the short straddle and strangle was a very good strategies for 2020 to 2020, 2021 and all, where the market was in a very sideways movement. In 2023, people almost as a nightmare because short straddle and strangle didn't work out properly because there was a very wild movement and the VIX is also low. So this straddle and strangle, it is good to deploy when you have good premiums because with good premiums, if the market is in a slightly sideways as well, you can do some adjustment and enjoy the theta decay. So once you understood this, so in the same way, you can deploy this in, you can automate this trade. See, daily, see, you can go, if you want to do an intraday straddle and strangle. I think many people follow straddles and strangles as well. In the trading journey, because every beginner comes with a straddle and strangle strategy and try to do option selling and learn, because that is where a beginner starts, right? So let us understand in detail how to manage the risk, okay, and how to adjust the straddles and how to adjust the strangles in detail, and how to automate it. In fact, because straddles and triangle doing manually, it is nowadays it is very tough to do that. Yeah, of course you can do if you are doing it in a positional basis where you will have a lot of time to make the adjustments and all, because now the technology is growing, you can automate many of your things. So all you need about is to understand what exactly you want to do it. So let me demonstrate by giving a short straddle how you can automate. So for that, let us use the, we can do that in different platform. I'll be using the Quantman for the same. You can use Algo test, Retron, everything. So whichever suits you. So this is only for educational purpose, guys. So please don't take this as a recommendation. So you learn how to automate this and take your own decisions, informed decisions. So for that, let's go to create strategy and let's backtest it, like the straddle first, and then we will go to strangle. Okay, so to create any of the straddles in the algorithm, so there is, first you can backtest that and then we can deploy it. So this, in, if you come to the create strategy, you can start the date here, from which date you want to backtest. So as it became 2020 January to till date, let us see. Okay, we can do Nifty straddle. You can we can name this straddle as Nifty straddle, right? And here, once you come, group type, let us keep it single, and you have to choose a instrument, as we are choosing Nifty today. So let's go with the Nifty, add the Nifty here. It will come and stick on here. You can, these indicators are not required here. So let's delete it. So now Straddle is selling at the money call and put, right? So it's very simple. At what time you want to sell, you can to uh, define the system. So we have to give the system like enter when. So enter when, if you click it here, you will have an option of day of the week, time of the day, and days to expire, external. So there are a lot of options where you can use this. So in detail, I will tell you about how you can add it for a intraday short straddle. I will show you today only the intraday short straddle. For positional and all, it will, I'll cover it in the next class. So see, we have to choose the time of the day. Time of the day is equal to, so at what time you want to go for short straddle, you have to define this. Okay. So if you want, so 9:20, if you want to sell call and put, enter time of the day is equal to 9:20. First define the time, then we can decide the at the money call and put in the next step. So let us give the instruction to the system at what time it has to place an order. 9:20, if you place it, 9:20, 9:25, 9:30, different people use different time frame. It is left to you. It is just for a demo purpose, how you can automate. You just concentrate on the process. Okay, so exit when, till what time you want to run it. So it, again, same, choose time of the day is equal to, if you want to run it till, so please remember this will be in 25 hours, 24 hours format. So you can choose 255. Exit, I am keeping it as 255. You can keep 315 or 325 or 230. You can give company different timings. Okay, so whether you want to do the transaction details, whether you want to sell weekly or monthly, you have to choose it. You can choose either of them as per your rules. Where if you are doing it in monthly, if you are doing it better, you can choose it weekly if you are doing it for intraday, because weekly options the decay will be very fast because the time will be very less. So either if you don't want to have that weekly every changing, you can do it in monthly as well. So better to keep a monthly option in a positional and do it in a weekly. So there are multiple ways where you can adjust, right? So we'll choose the weekly, okay, and we don't want so spot price. So here you have to define what you have to do. So you have to add. It's a two-leg strategy: call option and sell option, right? Let's add another leg. So option here we have to choose the call option. Add the money one lot, sell it. Okay, and you can define the stop loss. It is always good to keep a stop loss on the premium base. Like if percentage wise, you can keep it. So suppose if there is a huge uh, movement, okay, you can define the stop loss of 30%, 40%. See, if you want to make this strategy directional, in the sense you can create directional straddle as well. If you keep 15% stop loss and move to the cost, you can move to the cost option is there. Move to cost option is not here. So let us see. You can actually in Algo test it is there. Move to the cost. Okay, we can sell it. Let us keep some 50% stop loss on. See, suppose straddle selling at the money, usually the premium would be around 120, 130, or 150 sometimes if the VIX is high. And it changes on expiry day, it may be very less. And of course, to better to keep 50% stop loss. Okay, and you can give take profit as well on the percentage wise, or you can just leave it. So first I will just show you the plain straddle, how you can automate and you can back test it. Okay, there are a lot of adjustment what you can do here. You can add the adjustments and move the straddle. It is not required. So let's do it in a plain straddle, understand the statistics, then we can look at the changes what we can make as per the back tested results. Okay, so there will be an option to have a overall strategy stop loss as well and the take profit as well. So if you want to keep overall strategy stop loss also, you can keep it, and maximum transaction per day. Okay, so let's keep it only one, and let's see morning 9:20 entry, and if we have followed this step, selling straddles on daily basis from 9:20, how much would be the result? You can run the back test here. So this is a plain straddle with 50% stop loss. You can have different stop losses as per your system. So if you see here, so the profit curve, the winning probability has been 67% and risk per trade is 1.41%. So the number of trades, see loss, average profit is 1,160. Okay, so these are all the results. So yeah, almost every month it has been in a positive ways, and sometimes it has not given much of the profit. So it's all only two trades. You can have in detail about how it has been taken the trades and what is the profit and loss. See, 2000, 2700. So all these days, in recent days, it is not giving good profit as the VIX is very low and the market is in one side direction, right? If you go and see how it has performed in the November, it has performed very well, 2700, 1300. See, it has entered at 920 and it has exited at daily. It will take, see, you can just automate this normal process, like whatever task you will be given. The system enters at a right time and enter at a right exit, and you can manually exit as well if you are getting your purpose is solved. Okay, and you can see the eight only one trade. It will sell the premiums. Maybe ninth was the expiry. Okay, but that is where the premiums are ultra low, and still it has made a profit. See, it has from 920. Stop loss was not triggered. Both lost their theta. decay is there. So if you keep on going, you can just see how it has been performing in the uh, historically. Okay, so then you can recheck. This is a simple straddle guys. So daily, if you have done this from 9:20 till 3:55, this is the result of the short straddle. So in the same way, you can just keep changing the strategies rules. See, few people follow 30%, few people, because this you can always define not to trade on Friday and not to trade on Monday as well, if sometimes, because Friday and Monday there will be no much decay in the uh, market premiums, because being Friday it will be just fresh premiums. It is very uh, slow decay will be there. So usually Tuesday, Wednesday it will be more decay, and Thursday anyhow either it has to become zero or it has to come at the stop loss has to hit. And to do that, you can again, if you want to add any trailing stop loss or if you want to change the stop loss entry, you can just copy and edit this. So that result is good. If you see that, if you want to change, that is a simple straddle, right? So if you want to do some adjustments also, you can do that. So suppose if you want to sell one more straddle, moving straddle, if you want to make it, okay, you can add the adjustment whenever this stop loss is hit. If you want to go for a new at the money selling, call or put, you can do that as well. It will be keep, because it will be always in the market. So again, when the movement happens, again, if there is a consolidation, if you want to run one more straddle, let's run one more straddle and see. See, there is an adjustment option here for premium users. So adjustments, if you ask, adjust when it will last for. So you can edit here, and there will be multiple option. If the first leg, so this is the first leg, guys, call option here. Call option is the first leg, put option is the second leg. Okay, if there are multiple options here, you can choose first leg options, leg stop loss is hit, stop loss percentage, or first leg option gain percentage. If there is a gain, you can book, you can give an adjustment. Second leg and strategy stop loss, there will be multiple. Say, suppose if the first leg stop loss is equal or above 50, we are given 50%, right? So we will type it 50. Okay, you can give add condition. If you want to add any other condition, you can just do it. And so let us define for the first leg first, okay, and then we can do the this one. So this first will do the adjustment for the call side. What if the call option stop loss is triggered? So the transaction detail is, again, if you want to sell ATM one lot with again 50%, you can do that. So it will choose the next ATM and it will sell one more, like say, suppose if it we have sold 29,000 call and put. If the 29,000 call is squared off, it will sell 29,100. When will the stop loss hit? If the market moves from 29 to 29,100, that is where you are being lost, and 50%, 100 rupees premium going to 150 rupees. If it goes to 29,100, the stop loss will be hit and it will sell another 20,000 at the money option 29,100. So if this adjustment is done, you can just add one more adjustment also for the put side. So if the second leg stop loss percentage is 50, okay, here what we have to do, you have to add a leg of put option, right? Sell put one lot. Again, if you want to place any different stop loss, you can keep it. Here, if you want to keep 30% stop loss, you can modify it, because the option is already under the market is already moved, and if you want to reduce the stop loss percentage, you can always do that. So that's how it is. No selling, no entry conditions, adjustment has been done. And this, if you want to re-execute or re-entry, you will have an option here as well. if you want to re-enter, and if you want to customize your adjustments, you can do it here. So here, let's backtest this and see. After this, if this will be a rolling straddle again. Again, if the stop loss is hit, it will sell one more call and put if the stop loss is hit. So these kind of adjustments also you can do it. See, if you see here in 2023 it has been doing good, but there is 63% of probability, almost the same kind of results what you get. Okay, see in every day, yeah. Let us understand in detail how it has been trading in recent days. Okay, so these are all on 6th December. Yesterday it sold, see, 76 rupees, 76 rupees. It sold at the money call and put. See here, the put stop loss was hit, and again it has sold a put 850. It came to 850, right? Yesterday, all of a sudden, it came down and it has stop loss is hit, and again it has sold at 52 rupees, got squared off it. See, that is the advantage of adjustment. So even though this loss is recovered here, and again the call option is in profit. So ultimately, yesterday it has closed in 300 rupees profit, even though the market moved violently yesterday. So it made a profit. So there are some times where you will make loss as well, because this option, if you see 550, 550, it has sold call and put, and this call option stop loss has been triggered because it is at 50 rupees, 105, or approximately 50 rupees. The put is covered. Again, it has sold one more call option. It was an ultra bullish, right? Again, the call option went into the loss. So in this situation, you can always use some multiple conditions, which I will explain you when we copy and edit this condition. If you can move the straddle as per your convenience. See, when you are doing the adjustment, you don't have to sell at the money call only. You can sell out the money as well once the stop loss is it. It depends upon your trading style. I am just demonstrating how you can automate it, right? So even though the simplest to simplest strategy, you should be able to generate it. So see every day. So this here without stop loss, it has triggered. It has given 1,000 rupees. So on daily basis, on what see here, it has given some ninth number. See usually on the expiry day, the decay happens if there is no wild movement, if there is no gamma effect, you will get a good premium decay, and you can always change the time as well. You don't have to run it till 255. Sometime in 1 hour, 2 hours, if the VIX is high in the opening and VIX comes down, so in 1 hour or 2 hour, you will be getting your returns. You can just square off and go for another this one, straddle or strangle. Okay, so let's see how it has been performing till in September, almost every month. See, if you see here, every month it has been performing. It's left to you how you are doing your strategy goals. Okay, this is about the straddle. I cannot show you in detail about different strategies and all. You try your rules in the way you want to get the better results. Okay, so that is very important, right? So learning is growing. I believe in learning and growing, because until and unless you learn it, so you will be not having that confidence to deploy it. So that is where you have to learn in detail, because there is no strategy which will be giving you lifetime return. So every time, as per the market dynamics changes or market parameters changes, you should know how to modify your strategies, because straddle and strangle worked in 2 years back, and 2023 it was not working, and 2023 some other strategies are working. You should concentrate on that as well, and it is not like that in future it will not work. Again, if the market says some 20,000, it has become sideways from 20,000 800 to 21,500. Again, the straddle may come into the performance. So usually it is good to have the strategy details in place. You understand the strategy, when it will work, when it will not work. So now let us see the strangle, and let us build the back tested of Let's create the strangle. I hope everyone is clear here. If you have any doubt, write it in the comment. I'll try to address it. Okay, so let's create the strangle. For strangle, what is the rules? Rules is like selling OTM call and put, right? So let's backtest this. I'm showing you from the scratch so that you will not get confused. I have already strategies built in my place. Strangle. Strangle. Strangle Nifty. Okay, Nifty Strangle. Let's do it. Let's add the Nifty index. Okay, and we don't want this indicator, just remove it. Enter when we will give the same time of the day is equal to. So Strangle we can better enter at 9:30. Okay, so that the options get settled. You can define it whatever time you want. 9:25 is also good. Okay, exit when is also you can give time of the day or is equal to 15:15:00. 3:15. Let's see what happens because we are creating this for theta decay, right? As and when you go for a longer time, you'll get more decay, and of course, if market moves violently, your stop loss will be get hit. But you should know how to adjust those scenarios. It's all about the probability, right? So here, when you comes to option selling or option buying into trading, it's a game of probability and it's not a game of profitability. So you should know how to adjust when the probabilities, the uncertainties. You can predict the uncertainties and keep your risk management in control so that you will not lose much when you are losing and you will gain a decent amount when you are gaining. The risk to reward, if you can manage, that is where you can be always a profitable trader. So exit when is we have given weekly option we can stay. See instead of here you can go for OTM and this one. If you want to go for a premium based, you can choose premium based strategies as well because a lot of people get confused with like how you saw, like if we sell OTM one call and put, the put delta is vanished, only zero point 0.1. The call delta was at 0.35. So instead of that, you can choose the premium based strategy of say 80 rupees or 100 rupees or 50 rupees. You can define the premium. Okay, let's go with the premium base so that we can, this will become a delta neutral strangle. Okay, so we will not trial the, you will have a trailing stop loss. You can just go and try it out, trailing the stop loss and all. So I am just showing a plain strangle. Okay, so let's call and put select it. So one lot we are selling it, right? And the premium you have to decide how much premium you want. Say suppose if you are selling 55 rupees premium on daily at 925 rupees, 925 time. Okay, we can keep a stop loss of say around 50%. 25 rupees is the stop loss. So let's keep it 50% so that so 25 rupees will be the stop loss, right? Almost 25 5 25 plus 27.5 will be the stop loss if it is going above this one. Okay, you can keep overall strategy stop loss and take profit. We can keep take profit whenever we get 70% of the premium or 60% of the premium. Overall stop loss, we have already defined it in individual. Here we can give move to cost. The other strategy, if you want to move to cost, if this stop loss is hit, the other stop loss will move its stop loss to the cost. Okay, you can trial the profit and you can give the take profit in here individual level as well. If you are getting say around 50% of the profit of the total premium you can take. So it's all left to you guys. I think many people, because nowadays straddle and strangle until and unless you do your own adjustment, you are not coming out with the profitability. Okay, many things have to be changed on a daily basis because the VIX is sometimes yesterday, if you see, the VIX was 6, 7% up, and today it is 7% down. So that is how it will be keep changing. And you should know, if you are a Straddle and Strangle user, you should know in depth of what it is. If you don't know about the VIX and if you are doing the Straddle and Strangle, you are bound to lose it. Please be informed, understand in-depth knowledge of what are all the things which will affect the option premium. VIX is volatility index, which will has a very direct impact on the option premiums and the implied volatility of the option premium. So that is where you better take a stop loss and trade it. So maximum transaction you can define how many, or anyhow it is only from one straddle. So let's backtest this and see what will be the result if you have sold for 55 rupees. This is Strangle running from 925 to 350. See this also, it has given 51% of probability. Okay, this is just a demonstration. Okay, so in 2022, you can change the premiums and just try it out by yourself. So Strangle, if you see in today's market, the stop loss like is the call option, put option got triggered here, and the call option got squared off at cost. So if you see, we have not lost here, okay, and we have lost here. Once the stop loss is it. Again, you can add the adjustments here. Okay, I will show you quickly how you can add the adjustments as per the your this one. Okay, if you can see all the data, you can just backtest it by yourself and see. So let's, if you want to copy and edit, if you want to do any changes, you can look for, let's see for 100 rupees premium and 100 rupees premium. Okay, and adjust it. 100 rupees premium, let's not take the profit, let's adjust it. Okay, adjustment also you can do it here, add adjustment. Okay, add adjustment when the first leg stop loss percentage is equal or above the 50%. Okay, and you can add a leg and you can sell. Now you can sell a call option worth 80 rupees. So once this 100 rupees call option got triggered at 150 rupees, then you can sell 80 rupees call option again with a stop loss of 30% or 40%, however you define it. So it's usually, and you can adjust it only on the call side and leave it on the put side, and you can adjust only on the put side and leave it open for the flat side. Let's not do some adjustments with the call side, because market usually it's designed in such a way that whenever there is a fall, it will tend to move upward. And if you are like following any technical indicator, when there is a bullish trend, all the indicators showing the bullish sign, you can just avoid the call adjustment and do only the put adjustment. Only when there is a sideways movement, you can do some adjustment. These are all the things you should know. Nobody will tell you all these things in the market. You have to learn it by yourself and build your strategies on your own, so that you cannot blame on anyone that straddle that person gave that straddle that. And all rules are different. You learn everything. You do your mathematics. What makes you to take this position. So that is how you have to learn all these things, then implement it on your account. So let's do adjustments on the both side. Anyhow, I have told you how you can avoid doing some adjustment. So today, let's see, we are in adjustment. We are selling again one more call option. Let's add one more adjustment when for the put. So leg one over here, leg two, let's do leg two stop loss percentage is equal or above, say about 50%. वहाँ पे so we whatever stop loss we have given here, it is better to click on that. Okay, and if the stop loss is it, what we have to do is sell the put. Okay, again you can sell double the lot of put and make it a strangle moving upward side. Let's do two lots. See, it is all again, it's left to, you should understand the selling margin will be high. You need to have good margin for this. And of course, if you buy the hedges, you will get the margin benefit. I will show you how you can buy the hedges on a weekly basis if you are running intraday straddles and strangle. You just buy out the money 10 call and put and leave it on uh, Thursday or Friday, Friday to Thursday, you can keep it. And that hedges will give you margin benefit if you are running all these straddles and strangles in the algorithm. So let us do two lots of put adjustment selling 80 rupees and see. Okay, and no stop loss and no exit is required. Let's run the back test and see. Uh, which is a adjustment strangle. With a we are moving the strangles so that in the upward direction, because if you see here in the option, so if you see here we are selling out the money one, out the money two, and we are selling put two lots. If you see, if you sell two lots put, it will slightly increase. So there will be a cushion for the upward movement. See, if you see here, 62% is the probability, 0.7%. Okay, in 2023 here it was making good profit because it was a bullish market. We do double the put, and now it's, let's see here. So it's just an example, guys. So there is no hard and cold rule. You have to adjust only this. If you want any, I'll be teaching all these strategies in details in my workshop. I will make a separate video on that. So this is just basic. See, here if you have to 20,900 call and put, it has sold, and here see this, it has sold double the quantity of put again once the stop loss is hit, and it has, this stop loss has hit, and this, hope you understanding, right? So call and put, it sold, strangle out the money, okay, with an option premium of 100 rupees. So this stop loss got hit and it sold two lots of put, as I told you. See, that is where it has made 4,000 profit. In bullish market, if you sell two lots of put, and that is the advantages. You have made, we have made this one. So in 30th, let us understand what it has been. So it has sold double the lot of put, and that also went to the loss. So you might have seen on 1st December, if it is a bearish market, that is how you can lose it. So it is better to do on both the side adjustment and see, and you can check your own risk appetite here. So and all these grays were green. If the market is sideways, you will make good money. If the market is trendy, you may lose it. So to counter apart, you can have some buying strategies in place so that all these stop losses can be triggered. If you have a put, if you have deployed double the quantity of put and selling, you better keep one buying strategy for bearishness. So that will cover all these kind of losses. So that is what the strategy diversification is also important. I hope everyone is clear, guys, in straddle and strangle. You can just go for, once you have built it, you can go to my strategies. It will, whatever strategies we created, it will be here. You can choose any of the strategy if you want to deploy it. You can deploy it in live. Okay, once you log in with your broker, it will the API will be integrated and you can execute the orders. It is as simple as that. So let's meet in the next video where I'll be explaining about the bull spread, call bull spread and put bull spread, and how to automate those things. So hope you enjoyed this video. Please write it in the comment box if you want to, if you want me to cover any of the topics so that it will be useful to you. Thank you for watching. If you like this content, please like, share, and subscribe. Thank you. Let's meet in the next video.